Hi everyone, continuing from my past videos about language, this time I'd like to talk about some financial and economics and why never buy your car early. My motivation for making this video came from the video made by Phil Town, who is a very well-known investor and a lecturer in the United States. So he basically talked about 6 money traps to avoid in your 30s, including buying a home out of your price range, spending too much, not investing, and so forth. And one of them that took my attention was buying a car out of your price range. I listened to his video on this topic, but he never explained in details, like in terms of finance and economics. So I wanted to illustrate this point by adding an example of my own and support his claim with some details from a book that I love so much, which is Rich Dad and Poor Dad. So basically, my PowerPoint slides and video will be based on this book, Rich Dad and Poor Dad. I read it a long time ago, and I still think it's a very good book. So I strongly recommend this book to those who haven't read it yet. Basically, what this book is saying in principle is that you need to increase asset and decrease liability. Then what is an asset and what is a liability? Asset is property that creates positive cash inflow, whereas liability creates negative cash outflow. So for example, if you take a loan from bank, you need to pay interest on those loans. So that's a liability because it creates negative cash flow. On the other hand, if you deposit your salary into a bank, the bank pays you interest. So that's an asset because it creates positive cash inflow to you. With these definitions in mind, the book goes on to emphasize the 20s and 30s accumulation of assets. Let's look at the cycle below. So first, you save money from your salary. Using that saved money, you invest in stocks and whatever assets you can buy. And these assets start to generate cash inflow. And cash inflows basically cover a lot of living expenses. And with remaining cash, you buy assets that generate further cash inflow. With this virtual cycle, you start to accumulate assets that gives you more money, and with the more money you have, you start to invest more and get more assets. And this is a step in secret to become a very rich person. What about a car then? Car is a liability, and it's a very toxic liability that will suck your money and asset out of your life. Let's consider this scenario. John and David just graduated from college. They started to work and they got their first paycheck. John bought a car, but David started investing. Do you know what this simple choice in their 2030s would result in their financial assets in 5 to 10 years later? So John and David started from the same line. Let's assume that they're getting paid US average GDP per capita, which is 60,000, and their living expenses, tax, and other expenses are laid out under the criteria. So basically, I assume that they start with yearly income of 60,000 and with disposable income of 18K in their first year. But as I've already mentioned, John happily bought a car, and according to this table, he's going to be only left with yearly disposable income of 5,300. So let me explain to you how I came to this table. So he purchased a car, and monthly disposable income starts with 1,500. So basically all the payments, expenses relating to a car is taken from an article on the average prices, like principal payment, interest payment, insurance, maintenance, oil and gas, tax, and so forth. So I've taken all the average figures into this table. And as you can see, buying a car doesn't just cost a car, but comes with a lot of other additional costs such as insurance, tax, and so forth. John is left with is $5,386 of yearly disposable income in the end. And let's compare that with David, who just started investing right away with his first paycheck. So he has 18,000 yearly disposable income and started to diversify his investment portfolio by putting 30% of his income into bank deposit, which earns about 2.5%, the rest of 70% into stock investment. And I simply assume that he's going to earn about 9.8%, which is S&P 500 annual growth of the past 90 years. And let's have a look at this table. So with his investment into bank deposit and stock investments, 5 years after David has about 105K, and 10 years after he has about 260K. And of course, I assume compounding interest rate and reinvestment in deriving this table. But John, who just have $5,386 left in his hand, just deposit it into bank account because, well, 5,100 is not going to make a lot of difference even if he started investing. So assuming that he has put all his disposable income to banking deposit, 5 years after, John has about 28K, and 10 years after, he has 60K. Well, the numbers sound really, really low compared to what we just heard from David. So let's put them together and compare what John and David has. 5 years and 10 years after, the difference is about 77K. And 10 years after, the difference is 200K. That's a huge difference. And of course, this is a little bit hard to generalize because everyone's salary, everyone's living expenses, the rate of return, deposit, everything is so different depending on individuals' circumstances. But what I'm trying to say here is that with the compounding interest and investment, if you started investing early, that will make a huge difference in the long run compared to those who haven't done so. I just wanted to say that car was just one example of liability sucking your life out. How about liabilities out there that look like an asset but in fact is a liability? Example is a house. Isn't housing an asset as everybody believes in? Let's take a look back at the definitions that we just covered of an asset and liability. Again, asset is a property that generates positive cash inflow, whereas liability is a property that creates negative cash outflow. Well, then let's have a look at question again. Is housing an asset? And the answer is, it depends on your circumstance. If you're buying on housing with a huge amount of mortgage loan and half of your income goes to interest payment and principal payment with no cash to reinvest, then it's a liability, not an asset. But on the other hand, if you have enough cash from asset already you have built up to help buy housing and financing the loan, and you don't have much, burden on interest payment and so forth, then it can be an asset because housing can go up in price as well. Of course, there are exceptions. If your family is already wealthy enough to afford a car and give it to you, then why not? So here, this example shows the power of compounding and what is called the snowball effect. Even if you invested a small amount of money at early stage of your life and career, it will become a huge amount as the time goes on and the interest you earn on that money gets reinvested and earns interest again. So the asset difference from buying a car gets bigger at the first moment you get your first paycheck. And this difference just gets larger and wider as we get married and increase our spending inevitably. And this is precisely why it is such an important job for you to start investing early and build asset base at early stage of your life, preferably in your 20s and early 30s. But unfortunately, not a lot of people know this simple rule. And a lot of people just fall into a trap of running a treadmill, just constantly doing the same thing over and again without much difference. So this is what poor dad does. He gets salary from his paycheck, he pays tax, and whatever is left over from paying tax, he spends on his living expenses and interest payment and other unnecessary luxury stuff that he bought. As his toxic liability pretty much sucks his money out of his pocket, he has nothing left for investment. And this life goes on and on until he retires, pretty much left with nothing. Whereas rich dad, he creates an asset base from his early life because he saves money, and with his savings, he started to invest and built an asset. So he gets basically cash from asset along with his salary, use this money to cover tax and expenses, and with the left money, he reinvests again. This creates a virtuous cycle where his invest money brings in more money. In short, you need to create passive income even during your sleep. So the thing is, you need to come up with your own passive income asset strategies. And it does not have to be stock investment. Passive income is different from active income. And active income is traditional source of our income by having time multiplied by the rate of your salary. But passive income does not require your time input and simply earns from the past efforts you have made. So what could be a very good passive income? There are a lot of things that you can work on. And some examples that I can think of is first dividends. Dividends is leftover profits from the company, and the company pays out dividends to its shareholders. So building portfolio for dividend stock can be a good source of passive income because companies usually pay dividends regularly. And there's of course YouTube, because once you upload your videos to YouTube, it stays there forever. There can also be lectures and books, can be a rent from your real estate property, and etc. Even copyrights, I think sometimes can be traded. But if you look at these options, you'll definitely know that it's very difficult. Not everybody success on YouTube, and not everybody can have a lecture and print out books for sales. So this is why I strongly recommend stock investment, because everyone, if they do the job properly, can succeed in investing and earn passive income. There's a famous saying, YOLO, which stands for you only live once. And I definitely agree with this. Because you only live once, you definitely need to do what you want to do with your life. But there's a caveat. That once is quite long. And this is why you should start building assets and not buy a car early in your life. So far, I have talked about how we have to build our asset base so that it creates cash inflows for us in the future. And the earlier you begin, the better it is. But some people might wonder, not everybody succeeds from investing. They probably have some friends who went bust after investing, not a penny left. And they might ask me, you assume 9.8% return on my table calculation. And is that even possible to get that high return? Because a lot of investors are not getting that return, let alone people losing money. So next video I have prepared will address this point and will tell you how you can make money from investing no matter what. I'll take a little bit of different approach from all the other YouTube videos out there telling you what to do. So please stay tuned and subscribe to my channel if you had enjoyed my video.